From the parking lot, a shopping mall looks like one big building full of stores.
But the economics are very different from owning a single shop. A mall owner is usually a landlord, not the brand on every sign. You are not selling sneakers or burgers.
You are renting space, managing traffic, and trying to turn footfall into stable cash flow.
Welcome to Plain Money. I am Finn.
In the next 10 minutes, I will explain how owning a shopping mall actually makes money, what the biggest costs are, and why one anchor tenant can change the value of the entire property.
Let us start with the basic business model. A mall owner collects rent from many tenants under long-term leases.
Those tenants might include department stores, grocery anchors, restaurants, gyms, movie theaters, and small specialty shops. The owner also pays to operate the property, security, landscaping, HVAC, insurance, property taxes, and management.
The goal is simple on paper.
Collect more in rent and recoverable charges than you spend to run the building.
The main revenue line is base rent.
That is the fixed monthly or annual rent a tenant agrees to pay for its space, usually quoted per square foot. A lease might say a store pays $18 per square foot per year on a 2,000 square foot unit.
That base rent is the floor. It gives the landlord predictable income even before anyone asks how many customers walk through the door.
Many retail leases also include percentage rent, sometimes called turnover rent. After sales pass a breakpoint, the tenant pays the landlord a small share of gross sales above that level. This gives the owner upside when a store crushes it, while the tenant still has a manageable fixed base rent during slower months.
For the landlord, percentage rent is bonus income.
For the tenant, it is a way to align rent with performance. Then there are pass-through charges. Tenants often reimburse the owner for common area maintenance, property taxes, insurance, and sometimes marketing funds for the center. These are not pure profit. They recover costs of running shared hallways, parking lots, lighting, and promotions. But recovering them correctly matters a lot.
Miss billing, and your real profit is lower than the rent roll suggests.
Now the part most beginners miss: anchor tenants.
Anchors are the big draw stores that pull people in, like a grocery chain, department store, or cinema. They are not just renting square footage. They are the reason many smaller stores exist in the same building at all. Those anchors often pay lower rent per square foot than smaller inline shops. That sounds backwards until you understand traffic.
The anchor generates visitors the rest of the mall depends on, so the landlord accepts a discount on anchor rent because that traffic can be monetized elsewhere.
Inline tenants are the smaller shops in the corridors around the anchors. Because the anchor brings foot traffic, those inline spaces can command much higher rent per square foot.
A corridor location beside heavy daily traffic is worth more than the same square footage in a quiet center with weak anchors. The landlord is effectively buying traffic from the anchor through a rent discount, then selling that traffic to smaller tenants through a rent premium.
That cross-subsidy is the core economics of many shopping centers. The anchor is the loss leader for footfall. The inline rent roll is where much of the profit is made. So the mall is not really one tenant business. It is a portfolio inside one building. Gross income comes from adding up base rent, percentage rent, reimbursements, parking revenue, and sometimes advertising on digital screens or kiosks.
That top line can look healthy even before you ask how expensive the property is to run. Then you subtract operating expenses, staffing, repairs, utilities, management fees, and taxes not fully recovered. These costs do not pause when one tenant struggles. A landlord who ignores expense discipline can collect strong rent and still end up with weak profit. What is left after those expenses is net operating income, or NOI.
NOI is the key profitability number investors watch. It is the building's operating earnings before debt payments and before any big renovation budget. If NOI is rising, the asset is usually getting healthier. If NOI is falling, every other problem gets louder. Vacancy is one of the fastest ways to hurt NOI.
An empty suite earns no rent, but the parking lot, roof, and security costs do not disappear.
A mall with weak occupancy can look busy on weekends and still bleed cash if too many units are dark or paying reduced rent. That is why landlords obsess over lease expirations, tenant sales, and renewal negotiations. Tenant mix matters as much as occupancy.
A strong blend of grocery, dining, services, and entertainment can keep a center relevant even as pure apparel shrinks. Weak mix means fewer visits, weaker sales, and harder rent growth. In retail real estate, who your tenants are is not a branding detail. It is a cash flow forecast. Online shopping changed the story, but it did not kill every mall. Centers that only sold things you can buy on your phone struggled. Centers that became places to eat, work out, socialize, or solve daily needs held up better. Owners who reposition toward experience, services, and convenience often have a better shot than owners hoping foot traffic returns to 2005 on its own. Investors usually value a stabilized mall with the income approach. Take NOI and divide by a market cap rate. If a property produces $2 million of NOI and the market cap rate is 7%, value is roughly $28 million. That one formula explains a huge share of how commercial real estate is priced. Lower cap rates mean higher values. Higher cap rates mean the market sees more risk. For malls, tenant quality, lease length, and occupancy stability often move the cap rate as much as location does. Two buildings with similar NOI can be worth very different amounts if one has durable anchors and the other has rollover risk. That brings us to co-tenancy risk. Many inline leases say that if a major anchor closes or occupancy falls below a threshold, smaller tenants can reduce rent or exit. Lose one anchor, and you may lose traffic, inline rent, and tenant confidence all at once. NOI can fall while perceived risk rises, which can push the cap rate wider. Value can drop faster than the vacancy count suggests. Debt matters too. Many malls are bought with large loans. If NOI falls or refinancing gets expensive, the equity return can disappear quickly. A mall can have busy weekends and still be a bad investment if it was purchased at the wrong price with too much leverage and too many lease rollovers coming due. Who actually owns malls today? Often it is not one person with a giant key ring. Public REITs, private equity funds, family offices, and institutional investors own the real estate while brands lease the space. That separation is useful to remember. When you walk into a famous store, you are usually looking at a tenant inside someone else's building. Strip centers and regional malls are not the same animal. A neighborhood strip with a grocery anchor can be simpler, fewer tenants, shorter walks, more daily needs traffic. A large regional mall has more entertainment, more fashion risk, and more capital needed to stay competitive. The vocabulary is similar, rent, NOI, cap rate, but the risk profile can be very different. What should you take away as a beginner? A shopping mall is a rent collection machine wrapped around a traffic strategy. Anchors bring people. Inline tenants pay for access to those people. NOI is what is left after expenses. Value is NOI divided by cap rate, adjusted for risk. The building looks permanent. The cash flow is not. Your week 1 exercise is simple. Next time you visit a mall, ask 3 questions. Who likely owns the building? Which store is the traffic anchor? Which small shops are probably paying the highest rent per square foot for that traffic? You do not need a finance degree to see the business model. You just need to stop thinking like a shopper and start thinking like a landlord.
That mindset shift is the real lesson. A shopper asks what is on sale.
A landlord asks who is paying rent, who is driving traffic, and what happens if one big tenant leaves. Once you see the mall as a cash flow machine instead of a weekend hangout, the economics become much easier to understand.
If this helped, subscribe to Plain Money for more beginner-friendly explainers on money, business, and investing.
Comment with the mall near you that still feels busy but might be changing behind the scenes. Watch our real estate basics and business model videos next. The goal is not to buy a mall tomorrow.
The goal is to understand what you are actually looking at when you walk through those doors.